Good afternoon, guys. JR with Secure Metals Exchange bringing another technical update for today, Friday, January 18th. It's a brand new 2013, guys. I want to start off by wishing all of you a happy new year and lots of success here for the trading year of 2013. Now, being that this is the first video of the year, I wanted to make it a little bit different. So before I get to the technical analysis, I wanted to talk a little bit about the fiscal cliff and our current debt situation. Now, currently, apparently we have averted the fiscal cliff. The politicians have rounded up and have again saved us from what could have been quote unquote a disaster for the economy, right? So these guys got together and they formulated a plan on how not to take us over this so-called fiscal cliff. If you've been watching my videos, I did mention on my last video that this whole fiasco about this fiscal cliff was just BS. If you ask me, this is really just a distraction to get us to stop worrying about this $16 trillion debt. Now, by the way, this is a article that I pulled up. Very short article, really breaks down the fiscal cliff and really what happened. Now, apparently, we are raising taxes for a very small percentage of the population. But for those of you who think that taxes or your paychecks are going to stay the same because you're not part of that 1% or that 2%, maybe you forgot to read the fine print. Remember, when government does something, you definitely do want to read the fine print because it's not always as easy as it sounds. Now, again, you'll find the link below to this article. And so this is how it works. So the bill passed the Senate and the House, did not reinstate the payroll tax holiday that has been around for the last 2 years. So even though income taxes are going up for most people, aren't going up for most people, actual take-home pay will be going down. A lot of people forgot to read that part there. Now, more overall Americans who make less than $500,000 per year will see an increase of 1 to 1.4 to their annual effective tax rate as a result of the payroll tax rise. So even though you are not part of the group, you still voted for higher taxes for yourself, really. And it's very important that we understand that this debt here, this $16 trillion debt, has to be paid. Now the new thing is the debt ceiling. They're going to raise the debt ceiling. Of course, they're talking about possibly not raising the debt ceiling. The Republicans are threatening the Democrats. But again, if you ask me, this is all just bull. The debt ceiling will continue to rise and taxes will continue to rise. We have a $16 trillion deficit, and I think most people don't really understand or maybe can't grasp the severity of this situation. $16 trillion is 16 followed by 12 zeros. Now, if you look closely to this number, this is $16 million that we owe. The revenue, okay, let's say this is the revenue right here, 2.4 trillion. So 2.4 trillion dollars is what this government takes in, and what this government spends is $3.5 trillion. Okay, so again, I think when we see these types of numbers, we don't necessarily really sit down and think about these numbers and how we're going to end up paying this. And my prediction is in the next few years, probably the next 2 to 3 years, we'll see taxes go to, right now I think they're at 50% on the high side or close to it. But my prediction would be that in the next 2 to 3 years, taxes are going to go up to probably 75, maybe even 85%. To help tackle this big number here. And we're also going to see the government scramble. I think they're currently right now scrambling to pay off this debt. But if I'd like to break this down here for you guys. So instead of saying this is actually 1.6, right? 1.4, 16.4. So really, to break this down, what I wanted to do is I wanted to make this a little bit easier to understand, right? So $164,000. If we are living in a household, let's say if we're living with mommy and daddy are paying, and they owe $164,000, and they bring in roughly $24,000, okay? And they are currently spending $35,000, then what that means is that we have a long way to go before we can pay this. So the government has to come up with a way to figure this out. How are we going to pay this debt? And that's really what I was trying to figure out. When we raised supposed tax, so when we supposedly raised taxes just for the small 2%, it's not really going to create any type of, not even a dent here. And as far as this goes, the revenue is going to go up, what, a little bit more, let's say 5. So with that said, or let's just say it goes up to 6 with the 2%. We still have a long way to go. Again, we're running a big deficit. Actually, I think it's going to be more along the lines of this. So we still have a big deficit, even if we raised a little bit of taxes that we're going to raise. Now, again, this is the debt. This is the revenue. And this is the spending. So I'm trying to make sense of how we're going to pay this off. So again, there's only a few ways that a government can raise its revenue. That's by raising taxes. The next one is by purchasing bonds. And the third one is by what's the third one? By inflation, by creating inflation. Because again, remember, purchasing power is never lost, it's only transferred. So when we lose purchasing power, the government gains that purchasing power and they're able to pay off some of these debts. So again, for us to knock this out, even if we were to raise spending to, let's say 90, even if we were to raise taxes to, let's say 90%, 92, 93%, which we saw back in 1950, this is even if we raise it to 93%, this will only really go up a very small amount. Let's say it goes up to 28,000, right? So we still have a big problem. Even if we're able to bring this up to 35 to 45 somehow miraculously, because there's not absolutely no way we could do that. But even if we bring this revenue to 45,000, and Obama has made it very clear that he's not looking to reduce spending. So even if we raise it to 45, it'll still take us roughly 16 years before we can pay this off, and that's running a $10,000 or a $10 trillion surplus. So even if that was the case, it'll still take us about 16 years to get rid of this debt. Now again, debt is very poisonous, guys, and it does need to be paid. So even if they do this, we're still not going to get anywhere close to where we need to be. So what's the next way to make some money here for the government? Well, they can purchase bonds. Now, the only problem with purchasing bonds is that we're currently purchasing bonds with debt. Because if you're running a surplus and you buy bonds, and I guess that makes a little bit of sense, but if you're running a deficit and you start purchasing bonds, the only way to purchase bonds is with more debt. So again, this is not going to work all that much either, even though they're trying. We're currently spending $85 billion a month. We're printing $85 billion a month. So inflation is going to be the last way that the government is going to continue to pay their debt. So I predict 70 to 85% taxes within the next 2 to 3 years. I also predict, obviously, we all know that the bond market is in a bubble, and inflation is going to continue to rise. They are going to continue to print money. So again, don't let the debt ceiling bother you, because they're going to raise the debt ceiling. Don't worry about the money spending, because they're going to continue to spend money. Don't worry about them printing money, because they're going to continue to print money. They have to pay this off. If this is never going to get paid, if we stick to what we're doing, which is this. So again, I'm not an advocate of raising taxes. I'm just trying to make sense of how we're going to knock this out if we don't raise this revenue, or at least lower this spending. Now again, remember, anytime we vote for more spending, in essence, we're voting for higher taxes, whether it be direct or whether it be indirect. Now again, politicians love to raise taxes, but they like to do it in a very indirect way. They say that it's only going to be for the 2% or for the 1%. But again, the fact of the matter is, if that's what they're going to do, we're going to need a lot more help than that, because again, raising taxes up to 98% is still not going to do anything. Then again, you have bonds. There's only so much bonds that they can buy, so they're running out of that. They've already ran out of short-term bonds, so now they're buying long-term bonds, right? And of course, inflation is the last way. Inflation is really the most popular amongst politicians, simply because it's indirect and people won't really notice. Because prices go up so slow, people don't necessarily realize it until a few years have passed. So again, to summarize, guys, we need to raise this. We need to lower this. Obama has said already that he's not going to lower this. So the only option we have right now is by raising this. And the only way we can do that is by doing these three. As you can see, this one is really very ineffective. Bonds, you're going to run out of bonds, and inflation is the last resort. So again, I do expect gold and silver prices to continue to go much, much, much higher, because we do have to knock this out. Now, the cool thing about this is the revenue factor. They're going to continue to raise taxes, but the thing is that politicians are too smart to realize that when they raise taxes, tax receipts actually decline. So what I'm trying to say is that the more we raise taxes, the less they receive in taxes. It's just historically. I've actually pulled up two charts. I actually have three. I couldn't find something for the 50s when taxes were all the way up in the 90s. But I did find something that's fairly compatible to that era. Okay, so this is what happened in 1920, in the 1920s. In the 1920s, President Harding was really the last, the forgotten Great Depression. He was really the last politician that exercised free market. And of course, he mysteriously died after I believe it was 1923. But again, he was the last person that ignored the Federal Reserve's cry out for more printing of money. He was the last president that completely ignored everyone. This is another article here that you should definitely read, by Thomas E. Woods, a professor of Austrian economics. Really wrote in a lot of detail how there was another depression back in 1920. And we were able to completely do away with that depression within a matter of 2 to 3 years, simply because they did everything that we don't do now. This is basically what Harding did. And not surprisingly enough, there was no income tax back before 1913. The Federal Reserve comes in. Of course, they start the income tax. Income taxes went from 7%, surprisingly enough, by 1917. With just 3 to 5 years later, taxes had gone from 7% all the way up to 77%. That just tells you how greedy politicians are when you show them those little dollars. All right, so basically this is the forgotten depression. This is the depression that the government does not want you to know about. After World War I, we created a lot of debt, and what the government wanted to do was the government wanted to step in, and they wanted to they wanted to print more money and help the economy and control prices and so on and so forth. But President Harding did the exact opposite. Okay, the conventional wisdom holds that in the absence of government counter-cyclical policy, whether fiscal or monetary or both, we cannot expect the economy to recover, at least not without intolerable long delay. That's really the definition of a depression, right? Yet the very opposite policies were followed during the depression of 1920 to 1921, and the recovery was in fact not long in coming. By that year, the employment had jumped from 4% to nearly 12%. And GNP declined 17%. No wonder that that Secretary of Commerce Herbert Hoover, falsely characterized as a supporter of laissez-faire economics, urged President Harding to consider an array of interventions to turn the economy around. Hoover was ignored. Instead of fiscal stimulus, Harding cut the government's budget nearly in half between 1920 and 1922. The rest of Harding's approach was equally laissez-faire. Tax rates were slashed for all income groups, and the national debt was reduced by 1/3. Federal Reserve activity, moreover, was hardly noticeable. As one economic historian puts it, despite the severity of the contraction, the Fed did not move to use its powers to turn the money supply around and fight for the contraction. By the late summer of 1921, signs of recovery were already visible. The following year, unemployment was back down to 6.7, and it was only 2.4 by the end of 2023. So again, guys, the free market can always correct itself, as we can see here from this chart here. This is the gold versus Dow. When you let the free market do whatever it needs to do, it will automatically stabilize. But of course, in 1913 came in, and the stability was distorted. And look what happens now. You have these represents boom, these represents busts. These represent booms, and these represents bust. And if we do a little bit of prognostication right here, prognostication is the action of foretelling, prophesying future events. We do this by studying the past. So if we study the past, what we can clearly see is that these booms go big, busts get bigger. The busts get stronger. So these booms are getting bigger, the busts are getting bigger. If we look at this chart, it's easy to suggest that in the next 3 to 5 years, gold will probably be trading at a ratio of 3 to 1 to maybe even 2 to 1. If that's the case, gold can possibly exceed $5,000 to $6,000. And again, these are not crazy predictions. This is based on studying history. The only way to tell what's going to happen in the future. And again, remember, guys, this is a study. This is an economic study, which is not a study of precision. Is really a study of probability. So what we can say is that these politicians are going to continue to raise taxes, and not realizing that when you raise taxes, this is what happens. This is where taxes were. And this is tax receipts here, dotted lines here. So this is what we're paying in taxes, and this is what we're receiving in this is what we're paying in taxes here, and this is what we're receiving in taxes. So these are the revenues, and these are the tax receipts. Basically, in other words, this is the amount of money that the government is actually taking in. So if you notice, as taxes go down, the receipts go up. And the reason why this is true is because the more taxes go up, the more of an effort people make to find loopholes within the tax system and pay less taxes. But of course, these politicians are way too smart for that. They're going to most likely continue to raise taxes, thinking that that's going to help. This is a great example here of a chart. So again, as you can see, the less we charge in taxes, the more the government actually makes. In the 1980s, we had the exact same thing. Taxes were pretty high. Taxes were actually going up, and as you can see, the receipts are actually going down. So the more taxes go up, the less the government receives. And I couldn't find something for the 1950s, but I wanted to make it compatible, and I wanted to make sure that no one thought that I was trying to hide what happened in the 1950s when we had 90% taxes. But what I did find was this. Let's see here. What I did find was this. In 1965, I couldn't find anything earlier. Again, all the links to all these sites will be up. So in 1965, we were collecting roughly a little bit less than $1 trillion in tax revenue. That's what we had. These were tax receipts here. As you can see, taxes are actually going up. We're receiving more taxes. And as you can see in this chart here, taxes in 1960s were actually going down, and then this is where this chart takes over, and you can see how we're actually taxing less and we're receiving more in revenue. So again, these politicians just really have it all wrong. It's really a shame that these guys are the ones that are running the show, and it's really a shame that we see these politicians, they do the exact same thing. Obama promised this and he promised that in 2008. If you voted for him in 2008, hey, great. You know what? Bush was doing a terrible job. He was raising the deficit. He was spending too much money. I mean, again, really, there's really no difference between both administrations, between Obama and Bush's administration. So again, this is not necessarily a shot at Obama. It is a shot at the people that didn't pay attention between 2004 and 2008. They voted for Obama thinking that he was going to make a difference. Between 2008, 2012, the guy didn't make a difference, and of course you're going to go vote for this guy again. So again, my point is we really need to start paying attention to results. Now you hear these gun laws. Guys, we are in debt $16 trillion. You can actually fast forward in time. So let's say if I were to go to 2017, this is, if things keep going the way they currently are, this is where we're going to be in 2017. $22 trillion in debt. We're going to still continue to run deficit. And of course, our revenues are the only way these revenues are going to go up is by taxing more. So chances are we're going to be paying a lot more in taxes here within the next few years. And again, inflation is also going to be a major factor as well, because again, that's the only way I see that they're going to be able to pay off these bills. So again, guys, we really need to pay attention to results. Anytime we ask for the government to do things for us, for example, this banning of guns and all these laws that are being passed, I'm not for them. I'm not against them, or actually I am against them, but that's not my point here. My point is looking at it a standpoint from, playing the devil's advocate. I can say this. If you want to incorporate more gun laws, you need to have a surplus. We can't be in so much debt because it does cost more money to enforce more regulations. We do need to hire more people. We do need to have people in line to enforce these new regulations that they're putting out. So again, Obama is a big spender, guys. Again, nothing personal. I like the way the guy speaks. He's a badass speaker. I think no one can deny that fact. But we do have to admit that the guy loves to spend money, and all these regulations, he's made it very clear that he is not going to reduce our spending. And again, this is a big issue, guys. So I do expect gold and silver prices to continue to go higher. My prediction is that within the next 2 to 3 years, gold will probably be anywhere between $2,400 all the way up to $3,000. I expect silver to go anywhere between $50 to $75 within the next 2 years. And again, this is all just based on prognostication, guys. You study the past, you try to make future predictions, and again, it's not precise, but it is very, very, very probable. Okay, so again, unless we see some changes in government action, unless we see some reduction in spending, this is not going away, and this is going to continue to go up. Eventually, they'll run out of this. This bond market is in a bubble, and of course, inflation is the next step, is the best way to tax people without allowing them to know that you are taxing them. With that said, guys, get out of the dollar and pay attention to what's going on. Buy gold, buy silver, buy tangible assets. This is not the next year. The next few years are not going to be for the dollar. All right, guys. So again, back to the technical analysis here. Let's do a little bit of gold analysis here. So as of right now, this is the weekly chart. Weekly chart looking nice and positive, at least for the moment. A lot of volume backing us up here. At least looking at this chart, I would think 710 is the current level that this chart is looking for. Again, stochastics are going up a little bit. We are above the 100 and the 50-day moving average. So currently targeting the 38% Fibonacci extension, as well as the 20-day moving average at 1716, and of course the 23% Fibonacci retracement. It does look like this is going to make a run to at least 1710, but again, we might find resistance at this line, or we might at around 1697, which we did this morning. We saw that price hit this morning, but again, this Fibonacci retracement held, and now the next target is 1710, 1717, the 20-day moving average. Again, volume looking nice, stochastics are looking nice as well. The daily chart not looking all that great. The daily chart is already starting to look a little bit favoring a little bit more to the downside, but again, we still are in the strong zone, so it could be just a few days before we hit this 1710 target. or again possibly even higher. But again, on the short term, not too bullish, but on the longer term time frame, it does look a little bit more bullish. Regardless, I personally think we've probably seen the low here for the year, maybe around 1630. It could be the case where we come back down and visit those levels. Based on this chart, we can come back down to 1660 or something. But again, nice volume coming up. So again, I do expect these levels to hold, at least these low levels of 1635. I personally expect them to hold for the rest of the year. If we look at silver, then the weekly chart looks nice and bullish. Stochastics are moving up. We might find some resistance here at around when the stochastics reach these levels. That by then these prices should probably be at $32.50, possibly even $33.50. Hopefully we'll be challenging the $34 range. But the weekly chart looks nice. I'd like this line a break so we can continue to go higher. But again, as of right now, 20-day moving average above us, 100-day moving average above us. Again, silver's a lot more volatile than gold. And of course, if we look at the daily chart, just like gold, it is getting a bit extended, and we are looking at this trend line here to find resistance here, as well as this 100-day moving average. So again, this is making a really nice curve, this 20-day moving average. I like that curve. So that's probably looking positive. And again, if we look at the long term, I would imagine we're probably, this line here will probably be the low for the year. I don't expect this thing to go much lower than that. Again, we have a lot of support here at this line, support at this line here, this long-term line. So again, I do expect the metals to move much higher this year. I'd like silver to test at least this level here, the $37 range, before the year is up. Possibly even higher, who knows? Again, we did start printing money back in 2011. It does usually take about 2 years, maybe a year and a half to 2 years before inflation kicks in. So again, I do expect higher prices within the quarters to come. All right, guys, that's it for today. Thank you for joining, and have a great rest of the weekend. And I look forward to the next video here pretty soon. All right, guys, take care. Bye-bye.